Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Connecticut and talk with Peter Schiff of SchiffRadio.com. Peter is the author of Crash Proof and CEO of Euro Pacific Capital. Peter Schiff, welcome back to the Keiser Report.
Thanks, Max, for having me on again.
Okay, so a couple of points, Peter Schiff. Number one, Ben Bernanke, Fed chairman, recently released a lecture series about why gold was not a good choice for a reserve currency, never has been, never will be. And he's been very stridently pushing this meme out there. Gold is never going to be used as a reserve currency. Second of all, SWIFT, which is the global exchange for money that people use to move money around globally, has unilaterally decided to cut Iran out of their business, which effectively cuts Iran out of the global access to international money transfers. And some are arguing that this, in fact, would put more pressure on gold to be considered a reserve currency. Your thoughts?
Well, first of all, on Ben Bernanke, as usual, the Fed chairman is completely wrong. He doesn't understand money. He doesn't understand gold. He doesn't understand the history of money. You know, the thing about Bernanke is he doesn't even understand recent history. He doesn't understand the history that he just lived through. Ben Bernanke basically said that the Fed's monetary policy played no role in the creation of the housing bubble. According to Ben Bernanke, interest rates and home prices are completely unrelated. He thinks that it was a pure coincidence that we had this cheap money under his predecessor and a housing bubble, that they just happened to happen at the same time, and there was no causal relationship between the 1% interest rates, the artificially low rates, and that housing bubble. In fact, Ben Bernanke even went further to absolve Freddie and Fannie of all responsibility. Ben Bernanke thinks the financial crisis, the real estate bubble, was simply the result of malfeasance on Wall Street, and the only fault he has in the Fed was that they didn't regulate Wall Street and the banks enough. So Ben Bernanke is completely clueless, and I believe that Ben Bernanke is putting the dollar on a collision course with disaster. He is going to print the currency into oblivion, which is why people need to be on a gold standard. People need to save gold. You can't trust these central bankers. They will keep on printing money. They will keep interest rates down. They are clueless about what drives real economic growth. And so they're going to continue to destroy the value of the currency. So if you're looking at gas prices or food prices, if you're planning on buying these things with paper, you're going to need a lot of it because the price is going to go way up. But if you want to preserve your purchasing power, if you actually want to see a reduction in your cost of living, the way to achieve that is to save gold and not fiat currency.
And on the subject of SWIFT and the fact that Iran was thrown off SWIFT, brings up this idea that gold is will be used as a reserve currency.
Well, I don't think gold is a reserve currency. Gold is a reserve. Gold is an asset. Currencies need to be backed by something. So you can't just back one currency with another currency. Currency needs to be backed by something real to give it value. So gold is better than a currency. It's actual money. It has intrinsic value, and it works much better as a reserve asset than some other piece of paper that intrinsically is just as worthless as what it's supposedly backing up. But I think as we continue on this, collision course, this kamikaze monetary policy, countries around the world that are holding dollars as reserves are going to be under a lot of pressure to replace those rapidly depreciating dollars with something real like gold. And I think foreign central banks are going to be moving towards a gold reserve system, and they need something when the dollar falls apart. A lot of foreign countries are going to need to have something behind their currency to try to show that it's different. Because when the dollar collapses, what prevents the yen from collapsing, or the euro, or any of the other currencies? And so what these central banks are going to have to point to is their gold reserves as something that would differentiate their currencies maybe from the dollar, some way to convince their citizens that their currency is sound and that they don't have to get rid of it, that they can hold on to it because its value is going to be maintained and it's going to be backed up by something real.
Okay, so Peter Schiff, I want to talk about this Japan situation. They are suffering catastrophic losses in the energy sector. They're down to 0. Nuclear reactors are 1, not working so well. And of course, this is forcing them to import energy, which is creating a trade deficit. And, this is then leading to the policymakers thinking that currency devaluation is in order, as much as 40%.
Well, the devaluation is only going to make the trade deficit worse. What's driving the trade deficit now is not that their exports are way down, but the cost of imports is way up. And if they weaken the yen, it's only going to make imports more expensive. In fact, after that earthquake happened and the Japanese interfered and they had massive printing and intervention to stop the yen from rising, I said that was the stupidest thing that they could do. I pointed to the fact that Japan was going to need to import a lot of raw materials, and a strong yen would reduce the cost of those imports and would help the Japanese economy. What I said back then was by deliberately weakening the yen, they were going to make it more expensive to rebuild. And that is exactly what happened. And the irony is, now that their trade balance has turned negative, they think that the solution is to debase their currency even more. The more they print in yen, the higher the cost of their imports are going to be. The real solution for Japan is to let the dollar sink, to let the yen rise, and that will bring down the cost of all the raw materials that they need to import, and that would help the Japanese economy and Japanese consumers.
Yeah, so Japan has, as people understand, a huge debt problem, and this has been funded with their savings, but now the savings rate is running out. The savings is it's less than America. It's getting very low. And this is causing the Japanese to go on foreign markets to look for funding to roll over their debts. But if the foreign markets believe that the economy is as bad as it looks, of course, it's going to be virtually impossible to fund.
Well, the problem that you're going to have with Japanese government bonds is because they're creating so much yen to try to keep the yen from rising against the dollar, pretty soon there's going to be a real inflation problem in Japan as far as the cost of living. And you're going to start to see inflation in a significant way rearing its ugly head in Japan. And now it's going to be different. So now they're not going to have the benefit of deflation and the ability to keep interest rates so low. Rates are going to have to rise in the face of inflation. Let's see, what if the Japanese see 3 or 4 or 5% or 6% inflation? The central bank has to raise interest rates, and that's when you see this big collapse in the Japanese government bond market. And then what is the Japanese government going to do? Because the cost of servicing its enormous debt is going to rise. Of course, the recipients of those payments also live in Japan, so they don't have the national income problem that we're going to have when our rates rise, but still it's going to have some structural problems within Japan as far as where is the government going to get the revenue to meet those higher payments? Is it going to raise taxes, or is it going to cut spending, and how is that going to impact Japan? But I think if the Japanese central bank decides that, well, we're not going to do that, we're going to try to keep interest rates artificially low the way the Fed is, even though inflation is rising, then yes, they would risk a big drop in the value of the yen and runaway inflation in Japan.
Right, but central planners, Bank of Japan or anywhere in the world, of course, they're not going to buy into this idea of raising rates, even though it might make the most sense. They're going to want to lower rates with the idea that it's going to boost exports.
It's not going to boost their exports. It's going to make their imports a lot more expensive at a time where they need those imports. And if they start to really increase the cost of capital in Japan, that's not going to make it better for Japanese exporters. And of course, a lot of Japanese companies now, they import components too from other places. They have factories all around the world. And if the yen declines in value, it's going to dramatically increase the cost of bringing in those foreign produced components. So it is not a panacea. In fact, I think the biggest problem in Japan, the reason they have these debts in the first place, is because Japan has been committed to a policy of propping up the US dollar. And the irony is China has basically been following in Japan's example without understanding how much Japan suffers because they decided to do that. You have all these countries that are trying to gear their economies around selling stuff to Americans without any regard to the fact that we're too broke to afford any of it. And so you have this giant global vendor financing scheme that's about to blow up.
All right, so let's talk about the dollar. It's been pumped up by the Asian economies. It's showing some relative strength. You're a dollar bear. So walk us through the dollar story.
Well, I think the dollar has shown remarkably little strength in the face of all the European problems. Had we had this euro crisis 4 or 5, 6 years ago, you would have seen real strength in the dollar. I mean, you would see the euro well below parity with the dollar. Instead, the euro right now is around 133. It's relatively strong in comparison to where it's been historically. It's not at a record high, but I think the failure of the dollar to gain any real traction, even given the crisis in Europe, shows just how weak the dollar really is. I think what the dollar has found some support from the false narrative that the U.S. economy is actually improving, that the stimulus is working, that we're finally getting growth, that we're creating jobs, that we've turned the corner, that we've seen the light at the end of the tunnel. Pretty soon people are going to realize that that's not a light. It's the proverbial oncoming train. The U.S. economy is not getting better at all. In fact, it's sicker than ever before. And all the Fed can do is keep interest rates at zero indefinitely, pretend there's no inflation, even as it's about to rage out of control, and trying to justify keeping the economy on life support, which is what it's doing. But it's supporting a monster. The biggest problem in the U.S. economy is that rates are too low. Interest rates are too low. We're never going to have a real recovery until interest rates rise. But of course, when interest rates rise, we're going to have some short-term problems that result from the enormity of our debts. Our banks are going to suffer. The federal government's going to suffer because it can't pay its bills. The housing market's going to suffer. We're going to have a short-term contraction, a lot of pain, as we try to move from a bubble economy to a real economy. But for political reasons, the Fed doesn't want that. So the Fed is resisting the cure by making the disease worse, and eventually we're going to have to suffer that much more when interest rates eventually spike, because they will. And the longer the Fed keeps interest rates artificially low, the more damage we do to the economy, and the higher that interest rates are ultimately going to have to rise. And if the Fed decides that it's never going to let rates rise, well, then we're going to wipe out the dollar completely. The dollar will have no value at all, and we will have hyperinflation. That is the worst case scenario. I hope we avoid that. But the only way to avoid that means we're going to have to slam on the brakes, and it's not going to be, a soft landing. It's going to be a very substantial impact.
Okay, Peter Schiff, we're out of time. Thanks so much for being on the Keiser Report. Okay, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Peter Schiff of Euro Pacific Capital. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.